Good evening, this is Tommy Lackey, and tonight I want to do a quick review of the Brent situation here midweek, especially in light of the mixed price action we've seen. We're going to start off here with a new high, new low indicator. We had 137 new highs and 8 new lows today, but more importantly, we've seen these new highs surge up a little bit over the last couple of days. We needed that because they were starting to drop off, and that's allowing the new high, new low differential to keep some distance from the flat line. This is one of our major top and bottom indicators to help us get a better idea if we're in kind of a risk category for one of those. You don't get those signals too often, but they certainly are important ones when they happen. So we do want to keep an eye here, and right now it looks fine. Now we move from there over here to our McClellan indicator chart. The McClellan summation index is one of the more important mid to long-term indicators we use in the breadth world as well. And currently it's still pointing higher too. Still says that we give the benefit of the doubt till this rolls over more. And right now the shorter term McClellan oscillator, you can see, is showing a little bit of weakness, but it came down to the flat line and seems to want to bounce off of it. If that is successful and it does pivot here, then that's a really good sign that we have some more strength to come and that we are likely to see the markets make new highs and maybe move a little further. Now, many people right now are talking about these markets looking for a major top, and we've already said that we don't see that so far. And one of the things we want to point out is if you look at this advanced decline line chart and the custom index down here below, we might have a little different perspective on the current rally because we believe it really started probably somewhere over here when this November rally started. Now, a lot of people say, well, sure, we've been in a rally for a year, but no, I mean that's when the larger move started. Maybe not 2009, like many say. See, if you look at this chart, you can see right here, we had a major consolidation from early 2011 all the way to late 2012 in the advanced decline line for the entire universe I use for equities, but also the price action had a consolidation or almost a symmetrical triangle over that same time period. If you look at the SPY chart, you'll notice that in these areas right here that were lower highs in the SPY chart, they were higher highs. So the capitalization weighted index was showing us continuing to uptrend. However, if you looked at more price weighted, you might not have had the same picture. So that gives me the idea that maybe we're just now starting to rally. And maybe this rally is 1 year old, not 5. Just something to think about as we move forward. One of my favorite multi-time frame breadth views here is the moving average breadth, because we have the 20 simple moving average, the 50 simple moving average, and the 200, and what percentage are above and below that of the total universe. As we can see here, they're all clustering up here in the upper regions of their windows, and that's good. Again, that's showing strength. That means that there is help behind the trend, and something just as important you can see here is we had divergences developing on the October and December moves, October to December move. Well, those divergences have since been negated in that end of December run. So we're starting over with divergences as well, and that's something we look for a lot in these charts. So this tells me there's a chance these markets can continue to move higher. They don't look wildly overbought, and they don't look like they're stretched to a point. Now, short-term pullbacks or anything like that can always happen, and this 20 SMA may move on down some. If that does, that's fine, as long as these two in the upper levels keep a solid structure. So with the long and the intermediate term looking fine on the breadth picture, the only question we have is the shortest term. We already looked at the McClellan oscillator. It's kind of in the middle. We looked at the 20 SMA or percent above the 20 SMA, and it's holding up pretty well. And now we have the Breadth thrust indicator, which is a good short-term indicator, and it's kind of hanging out right in the middle too. Just really no extremes to work off of. But again, if it clusters up here above 50, as it did say back here in early 2013, you could see a good strong rally for a while before things get hit hard. Now, if it starts rolling over hard, then we have to reassess and get a new picture of where we are. And our final chart is the percent days. This is a chart that I originally started following with the data from Walt Deemer back years ago, but when I could stop being able to get his data, I decided to build it myself. And this lets us know when we have extremes. when in essence 90% of the volume and 90% of the uh, issues are advancing or declining in one day is a 90% day. Same thing for an 80% day. We look for these in the charts because they can signal short-term extremes, but I stress only use them in the shortest term. As you can see in this chart, we haven't really had much of that recently. The last one we saw was 1211 right before the previous rally did start. But again, only count on these in the shortest terms. And the reason I say that is because if we go back here to the last big downturn, look at all those 90% days. They're all over the place. So do not bank on this indicator alone, but it is something good to keep an eye on. So right now we have a pretty solid breadth picture. Things are still there. In the very short term, we could see a little more weakness, but until it starts deteriorating the structure more, we think that this pullback will end up getting bought. Thanks, and I hope this helps. Have a great rest of the week. Bye-bye.